and it's been a great conference so far. So I'm Jason Zweig from the Wall Street Journal, and it's my pleasure to be here. And I have two great panelists with me. To my left, a position he seldom occupies, is Dan Gallagher.
Sorry, just got it. It's great.
Dan was a commissioner at the SEC from 2011 to 2015. And he's now in private practice at Wilmer, Hale, and also, very interestingly, a new board member at Robinhood, the financial app. And to both Dan's and my left is Andrea Seidt, who is Commissioner of Securities for the great state of Ohio, position she's served in since 2008. So we're here to talk about the politics and the policy involved in Reg BI, and I don't think there's anybody better to kick us off on that than Dan, who really is steeped in the history of Reg BI, and you were very outspoken against the DOL rule during its formulation. If I remember, you called it misguided and rampant nanny statism. So how did we get here? And is Reg BI, as it stands now, a good thing?
Well, first of all, it's great to be here. This is a really terrific conference, Scott. Kudos to you. I love the more quaint gatherings with the nice mix of folks. I mean, you have some serious folks around here, and it's a great topic, and so congratulations, and really thrilled to be here. I was, as you know, Scott, I was in the pharmaceutical industry for the last 2 years, so I got to watch all this play out from afar, and was thinking blissfully the whole time, at least I don't have to get involved in Reg BI, and so.
Yeah, and there's no conflict of interest in the pharma industry.
Oh, no, I think I fixed everything before I left in last April. Look, the history, you can pick whatever point you want. I think we've already talked about Hammurabi's Code today in Roman times. I think if you go back to the New Deal, right, the 34 Act really codifies a system of oversight for brokers, which, at the time was sort of making federal law what had been practiced, right? The New York Stock Exchange in particular was the sort of de facto private industry regulator of brokers. All of a sudden, overnight with the 34 Act, they're a real regulator. They're an SRO with duties to oversee their members. And that was a system, I would say, that worked pretty well. Alongside of that, you had the buildup of the investor advisory business, which was kind of really small back in 34. There's a reason they didn't Congress didn't address the investment advisory business back then, because it just wasn't a big deal.
Yeah, it was really minuscule.
It was minuscule, and it was focused on mutual fund advisors. It wasn't a retail business necessarily in the 30s.
So Dan, just to clarify for a second, because this is a fascinating bit of history I'm not sure everybody's familiar with. If I recall from my days back in 1934, advisors primarily were set up to manage mutual funds or investment trusts, correct, but in their advisory capacity, they would handle some individual clients, often sort of the children or grandchildren of people who were invested in their funds.
Right. That's exactly
And that was the extent of the industry,
That's right? And it was so tiny that it warranted 3 pages of legislation in 1940, right? Yeah. The Investment Advisors Act, which said nothing, by the way, of a fiduciary duty. That was read into the legislation in, I think, 63 by the Supreme Court. But the industry grows and grows, while the brokerage industry, itself grows, but the system of oversight, the practices largely remain the same. There was a system of fixed commissions that was alluded to earlier today, which was done away in the mid-70s. And that opened up, different types of practices, variable commissions and things like that, a little more competition. And then, you see the evolution of this attention paid to conflicts of interest in the brokerage industry. Through the 70s, 80s, in the 90s, you had the Tully report put together, right, which investigated, unsavory practices in the brokerage industry, in particular focused on conflicts with respect to remuneration of brokers largely suggesting that fee-based models are better than commission-based models. And, for those of us who were kind of in the space at the time, we saw, funny enough, which I think is going to end up being history repeating itself here, a move on the brokerage side to more fee-based models than commission, with the imprimatur of the Tully report and the SEC behind it, in various rulemakings, allowing for fee-based remuneration by brokers. You see the shift into fee-based accounts, and then immediately the SEC come in and start looking at reverse churning issues, right? Churning being one of the biggest issues when you're in a commission model. Now, all of a sudden, you have accounts that are paying fees based on assets under management without any activity, and so you're actually paying more than had you been in a commission-based account. And so there was a reaction to that. There was SEC rulemaking, the 05 rulemaking that allowed for brokers, the incidental provision of investment advice, in a formal way. That was, of course, overturned. And then you have Chris Cox, my old boss at the SEC, commissioning RAND to come in and do a study, which was based on this idea, I think, that folks talked a lot about earlier, about confusion, investor confusion. Do investors understand these two models? On the one side, this Advisors Act fiduciary model. On the other side, the broker model, which, is one that I'll defend upside down and sideways, is regulated at the highest level by the SEC, at the lower levels through the SROs, FINRA in particular, and then the exchanges, which has a rule book this thick, but is based on the duty of care of suitability. Do investors understand that? And of course, as you might expect, it came back, conclusive in that investors do not understand that. Now, that was 2006, 7. My old boss, Eric Steery, Buddy Donahue was the IM director back then. They were hard at work trying to figure out if they could come up with a rulemaking that could get at this issue. Chris Cox was intent at the time of doing something. Then, of course, the world blew up in the financial crisis. And what we got coming out of that, of course, was DoddFrank. We were talking about how many pounds of paper. It's 2,317 pages. I think Ira was trying to, if you counted. And it was 100 rulemakings for the SEC. And then Section 913, which has been discussed earlier, mandated a study and allowed for a rulemaking, didn't mandate a rulemaking. Huge distinction, because there were about 100 other mandates of the SEC to go make rules, make public companies disclose the use of conflict minerals from the Congo, make oil and gas companies disclose material leases with foreign despots. But on fiduciary, they said, study it, and if you want to, and conduct a rulemaking that would create this uniform standard. They studied it in 2011. The staff report was put out. There was a split vote of the commission along party lines, I think 3-2 at the time. A lot of dissension in the ranks, and this was about 9 or 10 months before I came back as a commissioner. It was a very contentious report, all pointing towards a rulemaking that would create a uniform standard. Now, of course, in the background, you had the Department of Labor cooking up their fiduciary rulemaking, which they tried and failed at least once. Came back with their final rulemaking, which ultimately was vacated by the federal courts. And the SEC during our period, the period I was there, it wasn't so much there wasn't the vote. I heard that earlier that that Mary Jo just didn't have the votes. After Mary Shapiro left and she didn't get it done on her watch, Mary Jo didn't have the votes. We didn't have the bandwidth, the drive, or the predicate for the rulemaking, to be honest, right? The staff report, in many ways was, despite the best efforts of the staff, it's imbued with the politics of the 10th floor of the commissioners. I think it was, pushed in a certain direction. And, as we sat there looking at it with Mary Jo, it wasn't so much, folks like me saying, there's no way in hell I'm going to do it. It was, what's it going to be? Right. And we didn't have anything in front of us.
So that's a fabulous sort of walk up to what we have now. So let me ask both of you, and let me switch over to Andrea, and then we'll come back to you, Dan. So is Reg BI a good thing?
The money question, right? So NASA and the states, I think it's mixed bag there as to views on Reg BI, right? NASA did come out in support of the approach of elevating the conduct standard because we think it's raising the floor, even though it's not a full fiduciary duty standard. So NASA came out in support of the approach, but certainly not all member states were fans of NASA taking that position. We've seen states come out and do their own fiduciary duty rules because they think Reg BI is deficient.
And just remind us, Andrea, that is so far it's Nevada, New Jersey, Massachusetts.
It's been proposed in Maryland, never made it through. So some states decided they want to take matters in their own hands because they don't like what they saw in the Reg BI rule. And then obviously some states have even litigated and challenged the rule by suing the SEC. So states are kind of all over the place. Ohio is not party to the litigation. I certainly was involved in NASA's Reg BI working group and was involved in the comments. And so I personally think that the text of the new rule is something that regulators can get a lot of mileage out of. To me, best interest means something different and means something better for investors than suitability standard did. So I'm going to be cautiously optimistic that Reg BI will be a good thing for investors. But as we've heard this morning already, really the proof is in the pudding, right? So it depends on how the SEC and other regulators, including state regulators, which we have not heard a lot about this morning, interpret the rule for purposes of examination and enforcement. So my message to state regulators is that, we have a role to play here too. A lot of states automatically incorporate by reference any changes at the federal level, so they'll have the ability from day one to enforce Reg best interest based on their understanding of what would be in the retail investor's best interest. So I think states will actively push to give it its greatest investor protection meaning. So I'm going to say I'm optimistic that it's a good thing.
So I want to follow up on a hint you dropped, Andrea. You said, if I remember, you said that's not my interpretation of what best interest means. So do you have a different interpretation, and can you summarize what it means to you?
How I would define it. So I would go to Professor Spat. I would go back to, is aligning the interest, right? And generally, and we talk a lot about this in NASA comment letters, I don't know how you can interpret best interest to say we're still allowing broker-dealers to sell the highest cost, highest risk product out there when there are lower cost, lower risk, equally suitable products out there. It has to have, in order to be best, I think it generally has to be better. And you can't stick your head in the sand and only look at what you're offering if only thing you're offering is high risk, complex, illiquid products, right? So I think it means something more than suitability. Do I have a definition I can give you today? No. But I think that it is a facts and circumstances test in a lot of cases. And so the hypothetical scenarios that I think we heard Leo talking about and something that NASA proposed in its comment letters, the SEC needs to provide that guidance. And certainly when you're on examination, examiners are going to be faced with the real facts and circumstances out there, and they're going to have to make a call on whether or not they think these recommendations are in the best interest of retail investors. And so, the commission did give out some guidance. They did prohibit, for example, product-specific sales contests. That's never going to be in the best interest of a retail client, but there's a lot of unanswered questions. And so I think that's where regulators will be spending a lot of time, and certainly at the state level is something that we'll be looking at closely as we reform our examination modules and, and start looking into what the firms were doing before BI and after BI.
So Dan, is it a good thing?
Reg BI? Look, I think it's a good rule as written. I think when we were doing our prep call, you asked me, what do I like about it and not like about it, right?
Yeah.
I mean, I think the commission and the staff did an amazing job of taking the thorniest issue before the agency for maybe the last 10 years, putting aside money funds. I see Diane out there. She and I dealt with that issue. Putting that aside, this is and was and probably will remain the thorniest issue. So to tackle that in such a thoughtful way, to preserve optionality between the broker model and the advisor model, to do it largely in a principles-based way and to push down the obligations to just treat your customers well, to the firms, I think was terrific. Now, I go back though to first principles, right? The predicate that underlies the rulemaking, the notion that the brokerage chain was so horribly unsupervised, unregulated, that the abuses, were just so awful. And of course, in any market, there's going to be abuses, and we saw them in the brokerage chain. And that on the flip side, the advisor chain, the advisor model, the fiduciary duty is just this wonderful, exalted thing that will cleanse you from all your sins, was just wrong. Mm-hmm. It's just a wrong, false dichotomy.
Right, and I think on our prep call, Dan, you used the phrase, there was this false narrative about a critical need for this kind of regulation.
And it drove to the labor rule, right? And the labor rule. And
so why is it a false narrative? Because I think Andrea's itching to jump in.
Yeah, I mean, look, and I love the optionality. I love the fact that you have the ability to go to an investment advisor. They have their standard of care under the 40 Act. It's administered by the commission directly, no SROs. And on the flip side, you have the brokerage model. You can go there and have the option to have a commission-only, non-discretionary account, do whatever you'd like. Things that, by the way, were in jeopardy under the labor model. And so, but the false narrative of the advisor side is just, it's so much better. There's no conflict there. That it's actually factually and legally incorrect, right? The advisor relationship is established by contract, and even pursuant to a federal fiduciary duty that the Supreme Court found in '63, you can have conflicts. You just need to disclose them. And if you've ever gotten your hand on any of those contracts and looked at them, like I did back in my trading and markets days, as well as my commission days, you'll see some pretty substantial conflicts disclosed there.
Well, to be fair, it's not that you can have conflict, it's that there's always a conflict, isn't there?
It's both.
Is there such a thing as conflict-free advice? I personally don't think there is, by the way.
It's got to exist somewhere. There's always something, right?
Certainly more conflicted.
And some conflicts are worse than others.
Right.
So now let's turn over to Andrea.
So I started my job back in 2008, 3 weeks after Lehman Brothers imploded. And so I don't have all the history that Dan has. But I can tell you at that time, certainly securities regulation and broker-dealer regulation had the attention of the country and even the world, because we were going through this financial crisis. Billions and trillions of dollars, moving and being lost, real retirements, real homes being lost. And so we had a crisis of confidence in our financial markets and in our intermediaries. And so the reason DoddFrank was passed was really to restore that confidence in our markets. And to me, it's almost a false, argument to try to demonize broker-dealers versus investment advisors. Really, the reason why DoddFrank required the study was that we thought all retail investors expect their professionals, regardless of which hat they're wearing, to act in their best interest, and that the fiduciary duty is the highest regarded standard of care. And so why wouldn't you want to adhere to that standard? And really, in my state, in the 12 years that I've been doing it, 95% of broker-dealers and investment advisors that are out there working with retail clients consider themselves fiduciaries for their clients. They want to do the right thing and really aren't afraid of or want to shy away from a fiduciary obligation. But we're not there. And so obviously, a lot of folks have advocated against that. But that you can't say that there wasn't a need for this. We needed to do something in order to restore confidence and also ameliorate investor confusion, which is something we haven't talked about yet here, but we heard a lot about this morning. The study and the research is very clear that investors don't understand the differences between broker-dealers and investment advisors because they're handing over their life savings to a person that they trust, who holds themselves out and markets themselves as trusted advisors. And so, they don't understand the differences. And so if there is a different, conduct standard being applied, which there was and there now still will be, investors need to understand that. And I don't think Reg BI, although I'm cautiously optimistic that it'll be a good thing for elevating and ameliorating some abusive sales practices, I don't think it does anything to ameliorate investor confusion. While it might not widen the gap, it does nothing to reduce that gap. If you look at the Form CRS, for example, the way that they describe an investment advisor versus a broker-dealer in those forms, it uses the exact same language. It says, my conduct that I have, my conduct standard is that I'm going to act in your best interest when I'm giving you advice, if I'm an investment advisor, and the conduct standard for a broker is I'm going to act in your best interest when I make your recommendation. So if you're a retail investor, you're not going to see any difference whatsoever between those two populations, even though the conduct standards are different.
Well, I thought in the first panel this morning, Tom Selman and Ira Hammerman made a really interesting critique, and I'd be curious to hear what both of you think about it. I have some thoughts on it as well, namely that investor confusion may not be as material as it sounds, because if we mean that investors can't tell the legal difference between how the person managing their account is regulated, why does that necessarily matter? Why is that harmful to the client? How does investor confusion extend beyond that simple problem? I mean, if I'm going to someone who says I have to act in your best interest under Reg BI, why does it matter whether the person, formerly was under a suitability standard or a fiduciary standard?
Well, I think more important than understanding how the intermediary is regulated to me comes down to how much are you paying, right? I mean, the fee disclosure to me is the critical central point of all of this. And I think, the failure of the commission to get the point of sale rulemaking done 17 years ago now was actually part of the predicate for this rulemaking. In fact, a retail investor can't understand what they're paying. To me, that was unacceptable. As much as I might sit here and defend the broker model, I made the push very hard, for us to resurrect that rulemaking, for there to be a simple disclosure document and for investors to be able to understand what are you paying. As a brokerage client, during my time on the trading and market staff as well as the commission, I didn't know what I was paying, right? And it was just too opaque and too important an issue, because one thing we know about Americans, whether with investment products or anything else, they're shopping, right? And they like to compare. To do that, you need to know what you're paying. On the investment advisor side, you knew. You're paying 100 basis points, you're paying 100 basis points. Very simple. And I think that gives people a lot of comfort, right, about a relationship, about the environment that governs that relationship. And again, going back to my earlier points, I think too much comfort, right? You miss the fact in your advisor relationship, and again, this is not to disparage either chain. I think they're both great, product lines to offer to consumers, but you miss the point that there is no SRO, right? That all you have is the SEC, and despite the valiant efforts of our OC friends, there's only 1,000 of them dedicated to, I don't know what the number is now. When I left the commission, it was about 12,000 registered advisors. It's probably 15 now because of the migration into the advisor chain.
You have the states too.
Well, you have the states on the broker side too. So on the broker side, you have the SEC, you have FINRA, right? You have that rule book, you have the state securities regulators and the other SROs. There is a really comprehensive regulatory examination oversight network there that's way more comprehensive than the advisor side and should give you good comfort.
Well, so let me...
Hold on, before you move on, though.
No,
Let me
I wasn't
respond
going to move on, but go ahead, Andrea.
So, does investor confusion matter? Yes, it matters. It matters because there are different costs associated with the different models. And so I'm not saying one model is better than another. I do believe that a brokerage model is better for a buy and hold investor, but not all investors are buy and hold investors, right? And so regardless, what states would like to see is proper matching, that retail investors are matched up with the right type of account, and that advice and recommendations align with what's in their best interest. So generally it should be which account, what kind of investor are you? You should be matched to the proper account type. And then once you have that account, you should be matched with the right products and advice.
So how can we facilitate proper matching? Because that's a nice idea.
That's the obligation. I think investment advisors and broker-dealers under a best interest or a fiduciary duty standard do have that obligation to do the right matching. So if it's more expensive to be in a brokerage account based on that investor's objectives and needs, then they shouldn't be steered to one, and vice versa. So to me, investors need to know what they're getting into. If they're confused, they're not going to understand those differences. So there's a lot of similarities, but there are differences. And so we can't let investors be confused, because the cost that they will pay as a result of that confusion can be very damaging to the investors over the long haul. So it does matter. I don't buy the argument that investor confusion doesn't really matter. And also another, I think, condition that argument was built on is that the protections were equal protections under both regimes. I think there's rigorous protections and regulation under both regimes, but obviously they're not equal. They're not uniform. They have not been harmonized. We shouldn't pretend that they are.
So a thought immediately popped in my head, which is I was thinking of two of the, what I would describe as sort of the ugliest products that have been, well, I was going to say foisted on the public, but over the past decade or so. One would be private REITs, and the other would be equity indexed annuities, either of which can easily have sales loads in the 8 to 12 or 15% range sometimes. How confident are we that under Reg BI we're going to see less or none of such high commissioned products?
Well, I think, on its face, Reg BI should prohibit, your advisor, your broker from pushing any products that, to the extent feature, these high loads, that would adversely impact you as the end investor. So now the question is, and there was a whole rulemaking about this too under Chris Cox, the extent they're securities, Reg BI will be able to have that protection for you. When they drift over to the insurance side, guess what? The Wild West. Sorry, state regulator, but there's no federal oversight there in those products, and this is what we see. I mean, markets are markets, right? That brokers come in and out of the securities industry. They get kicked out by FINRA or the states, the SEC. They start pushing insurance products that look a lot like the security side equivalent, right? Especially the annuities, and there's really no regulation there on that side, which is a scary thought. And Reg BI won't extend there.
If we don't see reduction in those products, and we don't see reforms in those products, thank you. If we don't see changes there, then BI is a failure. All right. I mean, those are areas where those are products and practices that top state and federal enforcement action lists. They top the list when it comes to consumer arbitrations filed in FINRA arbitration cases. And so this is a huge source of retail investor harm. So if there aren't changes there, I think BI is a failure. And it really is incumbent upon the SEC and the state regulators to scrutinize those products more closely than they did under suitability under this new best interest standard to make it a success. I would also say that one of the things the states are working on, it's just started last week and it'll go on through this week, is we're doing an examination sweep on a coordinated national level. I don't think Texas has pushed theirs out yet, so I don't know if anyone in the industry has received one. Oh, there's a hand raised, so yes, they must have started doing this. So one of the things that we're doing is we're doing a baseline, we're going to create a baseline report. We're reaching out to both broker-dealers and investment advisors with 69 questions about what they're doing, what they were doing in 2018 before BI compliance. So before the rule was finalized, what were you doing? And we specifically ask about those two complex products as well as ask about private placements and leverage and inverse ETFs, because those four product lines were discussed extensively in the SEC releases, and it's something that we focused a lot of attention on in our NASIC comment letters because, again, there's a lot of retail investor harm. So we're going to take a look at what the firms were doing, both BD and IAs in this particular space before BI, and then we're going to go back out next year and through the first half of 2021 and go back and see how things have changed, if at all. Certainly our examiners will be expecting changes because we interpret best interest to require the broker-dealers to consider reasonably available alternatives. And there certainly are lower cost alternatives out there. And so there will be some tough questions, and we're going to measure progress. Someone asked earlier, how do we see if there's been a change? Well, stay tuned for NASA's reporting on this issue, because we're going to do something to look at where they were before, and we're going to see how they fare after.
Wow. So I want to shift gears slightly, and I want to I have a message for the audience. I'm personally very disappointed in all of you because we've only had one question all day from the floor. So when I'm done lobbing questions to Dan and Andrea, I'm going to ask for questions from the floor, and if we don't get any, I'm going to randomly pick a person to ask one.
Love it.
So if you don't want to be that person, I suggest you stick your hand up. And that's the paradox of the day for you to grapple with. So it seems to me that one of the critical issues that will always arise when a major regulation comes into force is the law of unintended consequences. The regulation may fail, but the law of unintended consequences will hold. And I think that's a universal rule. Do you guys have any thoughts on what the unintended consequences of Reg BI might be? Because I certainly have one in mind, which I'll get to after you guys go.
Oh, one thing that I worry about is that, it is enhanced oversight of brokers. There's no doubt about it, right? Suitability is still sitting there as the current, and I assume will be the continued baseline under which you cannot fall. So it's enhancing oversight. There are compliance costs. There's definitely new demands on the brokerage industry, and I think it'll only be incremental. It won't be a Department of Labor-like recast of an entire industry, but I worry that will just hasten the trend that we've seen, and I think Tom and Ira talked about it earlier. You just need to sit back and watch the flow of assets from one chain into the other. And those of us with enough gray hair have watched in the brokerage industry, who watched the money go, out of the big Wall Street firms and into the sort of independent chain. And there was regulatory concern about that at one point, as far as, is there a proper system of oversight for these little independents located all over the country? And now we've seen a trend undeniable in both the assets under management and the number of advisor registrations of the money moving into the advisor chain. And if that's because they're providing better service, better product, and better returns, God bless. But if it's the byproduct of just increased incremental costs coming from regulation, in this case Reg BI, then it's something that I worry about, because we could have fought this big battle to preserve optionality, and the market forces work against you. And the number of brokers, Ira was talking about it earlier, it's staggering, actually. It was up. It kind of mirrors the number of public companies in the United States. There's 10,000 20 years ago, and now they're in the 3,000s, I think, of registered broker-dealers in the U.S. Public companies, same things in the 4,000s. So these are trends as a policymaker you have to watch, right? And maybe it's market forces, maybe it's a good thing for investors at the end of the day, but it's definitely something you...
Andrea?
So I look at it a different way, not surprisingly. To me, the unintended consequence, hopefully unintended, is the dilution of the fiduciary duty standards for investment advisors. And so, I see, and I've even seen it in state enforcement actions already, where I've had respondents in our state cases cite to SEC guidance and statements of leadership to say, as long as I disclose it, I can get away with anything. All I need to do is disclose it. And so I fear that even investment advisors will start gravitating to some practices based on, I think they have carte blanche to do so as long as they disclose it. And that's something I don't think that the SEC intended, but certainly the companion releases for the 40 Act and the solely incidental interpretation certainly, again, continue to blur the lines even more between broker-dealers and investment advisors. And while they may move the floor up for broker-dealers, they are bringing the ceiling down for investment advisors. And we never want to see those protections lowered at the state level.
Yeah, my fear, for what it's worth, is maybe related to that, which is, and I've already heard anecdotal evidence suggesting this is happening, that the phrase, "I have to act in your best interest," is effectively being weaponized by people who've, for decades, not been acting in their customers' best interest necessarily, who were operating in a sales environment and who prided themselves on being big producers. And the very term big producer should make any person who cares about the public interest cringe. And I think if someone who has been striving for 20 or 30 years to be the biggest producer in the land can now say to people, "I'm legally obligated to act in your best interest as I sell you this thing that improves my production," that's not necessarily a good incentive in the context of Chester's slide.
I think that's an important point. I think one of the things that's interesting at the state level, we just did a recent member survey to figure out how many states had the word suitability in their regs, because if so, guess what? We need to modernize and update our regs at the state level in order to recognize and implement the changes at the federal level. And I think, 75% of the states that we surveyed that responded do have it. So we have to figure out what to do about that. We could obviously incorporate the federal change by reference by just simply ripping and replacing suitability with the words best interest and borrow the text of the rule, which I know a lot of people would like to see. But if those words best interest are tainted and they don't mean what we want it to mean, states may not have the appetite to do that. And so it really is important. The SEC is pushing out guidance. The states are actively watching that guidance to see what the gloss is with those words, because they were not defined, obviously, in the rule itself. And so what those words mean, I think, will influence what states do in terms of their own regulation, because if it's tainted, I'm not sure states will want to go there.
So before we throw it open to the floor for questions, which we'd better have, I want to ask one last thing of both of you. What do you think of Form DRS?
So look, I think it's going to remain to be seen when the compliance deadline is here, when we start seeing them in actual use, then the nature and quality of the disclosures, I think we can make a better assessment of it. I think right now it's, to me, a good idea. As I said earlier, well,
Why?
because I think the disparate nature of the various disclosures you get as a retail investor right now, it is confusing, right? One simple form where at least it's all supposed to be there, at least in general terms, and then hopefully some specificity on fees. This is the point I made earlier on point of sale. It's kind of nice to know it by regulation is all supposed to be there in one place and understandable. So, I look forward to seeing them in actual use, like I said, I think, but in theory, a good thing. Before, I got to take one step back here, because before we move on to questions from the crowd, one thing we haven't talked about, which is critical in this whole debate, is arbitration, right? The difference in your right of redress between the brokerage chain and the advisor chain, right? On the advisor side, you're going into state court arguing about a contract, and good luck to you on that when all these conflicts are disclosed in that contract, versus the FINRA administered arbitration system, which has been working incredibly well for a really long time, which, by the way, has been rewarding investors based on a fiduciary standard that didn't exist in rule for decades, I think is a choice that needs to be factored into your earlier question about understanding the regulatory regime and how impactful that is to an investor. Because in the worst case scenario, you get ripped off by your professional, you don't want to be in state court.
So, I'll start with Form CRS because that was your original question. And I appreciate and respect the concept. I do think, when you look at Form ADV, which is really kind of the model upon which Form CRS was based, they're lengthy. There's a lot of disclosure. It's not user and consumer friendly. So the idea of getting what is most important to consumers front and center in a short disclosure document is probably a good concept, and the only way we're going to get investors to read what is most important to them, because right now we know they are not reading it because it's too long. And so I appreciate the concept and think that we can get there. However, I don't think what ended up in the final rule really is the best way to execute that concept. In the proposing release, there were some really interesting ideas that would have helped consumers understand some of the key differences between the traditional broker-dealer model and investment advisor model. It highlighted differences for the buy and hold style investor versus the investor who wants to really have an ongoing relationship and active management over time. That all gets lost in the final rule. And there's just too much flexibility in the final rule. I really don't think there's going to be meaningful information for investors in the Form CRS is finalized, unfortunately. My opinion is, and I think NASA communicated this in its comment letter, what investors really care about is point of sale disclosure. So if you're going to have enterprise-wide disclosure of what the firm charges in terms of fees, the large firms are going to say, we charge everything. So you're not going to have a lot of valuable information in Form CRS for the big firms because everything is out there. What the investors want to know is which fee that you're disclosing on Form CRS applies in this recommendation. Which conflicts disclosed in Form CRS are present in this recommendation? I want to know where the rubber meets the road in this transaction. And unfortunately, Reg BI and Form CRS don't require that level of disclosure at point of sale. It's something else that we asked some questions about in the state exam sweep that I mentioned. We want to know what broker-dealers and investment advisors are requiring, what kind of disclosures they're giving at point of sale, to see what they're doing before and to see if they're doing anything in addition after BI. I'm not optimistic that they will be, but we'll be looking at that. So Form CRS, the concept I think is great. But again, I think from the state perspective, we would have executed that very differently. And again, I'm not sure that retail investors are going to be able to see the difference between broker-dealers and investment advisors based on the final product there. And then in terms of arbitration, I think that we don't have enough time to say that it's a huge success. It depends on who you ask, right? I think the broker-dealer community is a big fan of arbitration, and it works pretty well for them. I also think a lot of investors, it's a cost-efficient way to resolve disputes for them as well. But we and states generally would like to see the investors to have choice. You like choice? Give the investors the choice after the dispute has arisen as to whether they want to litigate or arbitrate that claim. And I think things would look a little differently.
So I have an observation about CRS that I've been dying to test on a large group, especially a group like this. So a show of hands, how many people in the room have recently updated or downloaded software or apps on their phone? I assume every hand in the room should go up. How many people got the little I accept button and the thing above it to read? Everybody, right?
Of course, yeah.
How many people read the thing they were supposed to read? Like Jay Barris and 2 other people. And that tells you all you need to know.
Barris and Selman.
That's right, yeah. Tom also. So I am profoundly skeptical that people who are, perfectly happy to put any old junk on their phone, even if they're afraid the Chinese government might be behind it, are going to read what to me seems like a kind of long and not super friendly document. In fact, I'm skeptical that people will read just about anything, including my column. So I worry that the very concept may be sort of culturally outmoded, or maybe based on a psychologically unrealistic view of human nature. And obviously Brad Barber will be talking about that over lunch.
Are you calling into question the whole idea of disclosure regulation?
That's basically it. I was just about to say the same thing.
Well, Brad is going to talk.
From a merit regulation state like Ohio, I might not disagree with you.
Brad is going to talk quite a bit about that. I think the question is not whether disclosure works, but whether it is both necessary and sufficient for investors to make good decisions. And I'll leave that up to Brad to talk about. But I think our regulatory regime in this country at every level places too much faith in the power of disclosure to bring people to optimal decisions. So,
I would give you a standing ovation for that, Jason. You know, I mean, if they're not reading the ADV, which is a 10-page document, right? Then maybe 4 pages is shorter and they're more likely to read that. But when it comes to the actual recommendations, the products that are being sold, let's use non-traded REITs was an example that you gave. We did a little exercise in Ohio to see how long it would take to read the prospectus front to beginning without the exhibits and without looking up any defined terms. And these are complex, documents, and we had sophisticated attorneys reading them. 12 to 14 hours straight read, not looking anything up. Do you think investors are reading that? No, they're not. And so if the only thing you're requiring in order to ensure that an investor understands what they're getting into is delivering a copy of that prospectus that they're never going to read, is that really providing them the information that they need to help them understand those products? And is that really meeting the standard of care?
Yeah, I can't be quiet on this.
Yeah,
This
no,
is,
please.
you already talked about nanny-statism. This is nanny-statism at its worst, right? Disclosure is the bedrock upon which the securities laws operate right now.
Yeah, true.
Now, there's a difference between disclosure overload, ineffective disclosure, overly obtuse disclosure, and the notion of having a disclosure-based system at all. And I'm all for refining, enhancing. You mentioned before that I'm on the Robinhood board. You should see the things you can do on an app to make even awful, opaque disclosure a little more accessible and understandable for folks. I think technology will help us in that regard, and hopefully chop up CRS and into bytes that people can understand, and especially through new media like apps. But the notion that we need to move away from it, and I don't know where you take that logically, right? We'll have the Central Command Bureau of Investing, and we'll hand out investments to everyone, kind of.
Right. Well,
Social
just to
Security
clarify,
minus,
I'm not saying I'm against disclosure. I just have serious doubts about whether disclosure alone gives people everything they need, which frankly is why we have financial advisors and why financial advisors are a force for good in society.
And why you have the regulators behind it enforcing these standards and bringing the actions and bringing real peril to the advisors, the brokers not following these rules, right?
Yep.
And that gives disclosure meaning when there's a consequence to not getting it right, not disclosing.
Right. Okay, so now it's your turn. And somebody better have a question. Yes. And just wait for the mic, please. And if you would identify yourself if you're not embarrassed to reveal who you are.
I took your threat seriously, so I came up with a question. I actually wrote it down. Steve Manuel with USAA. And I think with regard to disclosure and the dialogue, I actually think that most consumers spend more time reading the advisor and saying, can I trust this person, than the 14 hours that that would be with the prospectus or the ADV. And I think that's what's really important, but that then presupposes how much due diligence does that advisor do on that consumer. And so my question is, when considering best interest and fiduciary, do both concepts require equal depth and breadth of knowledge and understanding of the consumer?
Yes.
Yeah, I mean, I think Reg BI lays that out pretty cleanly now, which, is a difference with suitability, right? There was a much more check-the-box approach on the brokerage side with a suitability standard, and you can't get by with that anymore and satisfy the best interest. So
We would say they would have had that obligation even under suitability. They should always know their customer. They should be doing they should have been doing their due diligence on their clients and the products in the first place. But to the extent there was ever any doubt, I think Dan's right. That ship has sailed.
Great, thank you. I think we have one in the back.
Hi, John Griffin, professor of finance here. Related to the disclosure aspect, it wasn't my paper, but some academics did some analysis of words in RMBS prospectuses over time. And what they found over in the years leading up to the financial crisis was those disclosures actually got more aggressive in terms of what they disclosed, that these loans have all kinds of problems. They could blow up and kill your portfolio, not quite in those words. And so that in some ways was evidence that, it could be evidence that the banks knew that they were putting together some risky products and so forth. So I guess I wonder to what extent those disclosures obviously didn't help investors. They just made it harder for investors to sue on the back end. And so to what extent is all these disclosures basically, this is just a variant of your question, but are all these disclosures basically just legalese that's makes it very difficult to sue in any context, and it's really just it's just a boilerplate that's protecting protecting the people putting the so I disagree with the statement you made that maybe these disclosures are always a good thing. No, I think that it actually could be a harmful thing if you're disclosing something that basically is a disclaimer, like, okay, we can do whatever we want and you have no recourse. Investors are going to sign that statement. What else are they going to do? Because they're trusting their advisor. So, why would no disclosure not be better than that?
So, those good attorneys are doing what they can for their clients and entering that legalese. The first half of my legal career was on the other side doing things probably just like that. But now as a regulator, what I can tell you is that it's disclosure, while it's obviously an important part of the regulation, it's not the only part. And throughout the SEC's release and Reg BI, you will see that the standard of care cannot be satisfied through disclosure alone. So you cannot disclose away fraud, you cannot disclose away abusive practices. And so the question is, when we see that, how are we as regulators going to respond to that? But you're right. I do think that disclosure can be weaponized and used against investors, but there are limitations to that. Not a free-for-all. You can't disclose away fraud. You can't disclose away this merit requirement that the broker act in the best interest of the retail investor.
Yeah, and I think it's important to keep in mind in the RMBS market, you're talking mostly institutional markets. This wasn't Mom and Pa Jones buying our RMBS product. And so, an abject failure across a large part of the institutional advisor community there for continuing to buy the product despite the disclosure, and they suffered the consequences in a pretty hard way. I do think, the credit bubble, the mortgage bubble, it's a little bit oranges to apples as far as regular way disclosure with regular way securities products. So much of the disclosure, even if it was aggressive and accurate, was just ignored given the environment surrounding the mortgage bubble. But, I think in the retail setting, which is the conversation we're having right now with Reg BI, and I'm going to embarrass Diane again, because we had these conversations in the context of money market mutual funds. I kept saying to Diane, I want a skull and crossbones disclosure, literally a skull with an X through it saying, as a retail investor, if you're going to go into this money market fund, you may not have liquidity, right? You might not lose your principal, but you may lose liquidity, which is something, of course, that was experienced in 08. And she, in her wise and patient way, talked me back a little bit from that. But, it is an important balance. There is a point where you can't just, especially on the retail side, say, this is just crap I'm selling you and it's complete garbage. You certainly couldn't do that right now and satisfy the Reg BI standard. So it'd be incongruous with your duty under the new standard. I think it would be incongruous under the suitability standard too.
Yeah, your question reminds me of a tidbit from a speech that Benjamin Graham gave after the what a lot of people called the Great Garbage Market of 1968, when there were tons of IPOs of crappy little tech companies, and somebody asked him, what can we do to improve disclosure? And he gave a kind of despairing answer at the time. He said, I think the SEC could make companies stamp on the front of the prospectus and I'm paraphrasing, this security is worthless and you shouldn't buy it, all in red capital letters, and people would buy it anyway.
They would buy it anyway because they trust. This whole conversation is about people hiring people that they trust. They don't want to spend 14 hours reading the prospectus because they're paying someone they trust, a professional, an expert, to have read that beforehand, to know that it's an appropriate product for them. And so they're not going to read the prospectus. They're going to click OK. They're going to scroll through because these are all relationships. And back to that confusion thing, the reason it's confusing for investors, if you have a broker for 30 years who's handled all of your transactions for you, you believe that they're a fiduciary, that they're looking out for you. You don't think that it's a transactional, standard of care. You believe there's an ongoing relationship. You believe there's an ongoing duty of care. And so it's a real surprise to retail investors that are in that situation when there's no real differentiation in the service being provided, that somehow they have a lesser standard of care or more restricted compliance obligations. And so, again, that confusion point's not a small point.
Yes, we have a question up front. Well, the mic is coming then.
Hi, Tara from Charles Schwab, and this question is for Andrea about this national sweep exam. The states are coordinating. Is FINRA involved? Is the SEC involved? Is there coordination at that level?
So they're aware that we are engaging in this. We've shared kind of at a high level what our concept is. It's not all broker-dealers and investment advisors. It's a sample of them. We're generally asking states to do up to 100 firms, 25 broker-dealers, and 75 investment advisors, given the different sizes of those populations. Not all states will likely, do the survey, but we hope to get hundreds, if not thousands, of firm responses in order to compare those populations, see the differences in the practices before BI. And again, like I said, we'll go back out afterwards and see how things have changed if they have at all.
Anybody else? Yep, well, we have one here and one there. We'll try to get you both.
Hi, I'm Josh Broadhead with ACA Compliance Group. So we heard earlier today that this is a seismic shift for the broker-dealer industry, and it seems to me that there are a number of different stakeholders that could drive that change. It could be C-suite executives, it could be compliance professionals, it could be regulators through examination or enforcement, or it could be consumers. And so I'm curious about your perspectives around which of those stakeholders you think will have the biggest impact on the broker-dealer industry in the years to come.
Why don't you take that first, Dan?
Geez. I think all of the above. I do think, I agree with your earlier comments. It is seismic, and I do think it's going to impact each of those constituencies in a pretty meaningful way. I think the investors will be the ones that maybe take the longest to come along, right? Because they're not sitting here today waiting for this. I mean, it's sad to say, as big as it is, the awareness of Reg BI implementation, what it means, the timing. This isn't something that a retail investor necessarily knows right now. So, but hopefully and ultimately it will inure to their great benefit, and they'll, enhance their existing relationships, create new relationships, and provide better performance for them. But all the other folks are obviously sitting on the edge of their seat, anxiously awaiting this compliance date and measuring, if you're in the C-suite, the impact on your P&L. If you're in compliance, how the hell do I get this done in time? I keep hearing Jay Clayton tell me that he's sending the stormtroopers in June, and I would believe him on that front. Sorry for the stormtroopers in the room. So, I think all of the above from my perspective.
Yeah. Let's make this the last question over here, if we can get the mic.
Hi, I'm Tylai. I'm a student here at UT. So with Reg BI, with the increased standard of care and increased disclosures, one potential downside is that it may reduce the number of broker-dealers. Do you think that this is overall a benefit or a downside to retail investors with limited financial literacy or just lower amounts to invest?
We know what Dan thinks about that.
I did not plant him, I swear. Great question. He's brilliant. It's a concern. It's just something I raised before that, we could drive, further consolidation. That's not a knock to, the Schwabs of the world. That's great. They run a great company there. To the mom and pop small broker-dealer shops. It's just something like so many things in the American society that's disappearing, small town, small business over time. I do think technology will help tremendously, and this isn't necessarily speaking my Robinhood book, but the Robinhood is a straight up broker-dealer, right? And there's 10 million accounts right now. It's growing tremendously every year, and I think it's targeting folks like you guys, the young folks who I think is a good national policy to want you invested in our markets, in our economies, in our issuers. And so I think technology will help tremendously. Whereas the overall numbers of brokers might go down, the power and impact of those that remain, I think, can remain as large as today. And I hope that's.
So I think that's the false narrative, is that somehow people will not be represented and they won't get service or advice. I've heard in some states where there have been threats that I'm going to pull out of the state if the state fiduciary rule passes, and then there's lots of people saying, well, I'll take those clients. Go ahead, leave my state. Believe me, there's always going to be someone to come in. I do think technology has a strong impact. There are both broker-dealer and investment advisor robo-platforms that service retail accounts the cheapest way possible, right? Very safe, diversified mutual funds, low-cost ETFs, available for your average retail investors. Some of those are accompanied with free CFP financial planning advice, very affordable options for retail investors. I don't think anyone's going to go without advice. So I don't buy that argument.
All right. Well, please join me in thanking the panel, and let's eat.